Welcome back. You're still watching The Globe. Now, the financial situation of South Africa's consumers is slowly getting out of hand. The debt counselling company DebtBusters is warning that rising interest rates and higher inflation is driving consumers further into debt. Since the beginning of the pandemic, consumers benefited from a low interest rate environment. However, this is expected to change with the increase in interest rates that has so far gone up by 0.5% since November last year. Even less encouraging is the economic growth prospects expected to remain weak, with the economy only seen to be growing by 1.7% this year. Well, for more on how the soaring rates are affecting businesses and consumers, we're now joined by the chairman and group CEO of 360 Global Solutions Group, Mr. Khandani Msibi. Thanks very much indeed for joining us, and welcome to the program.
Thank you very much, Peter, and thank you for having me.
All right, so we know what happens when interest rates start ticking up. There are some people who are already on the edge, and I suppose an interest rate burden just takes them over that edge.
Peter, the theory of interest rates, as the Reserve Bank follows it, is that when inflation increases, they needed to increase interest rates in order to keep inflation under control. But there's one thing missing with regards to their application of this theory, that ordinarily there will be growth that is actually driving inflation. And then the Reserve Bank or the Federal Reserve will then intervene and almost balance the growth with the runaway prices driven by demand. But that is not the case with us as South Africa. And I think we're having the application of economic theory in a very destructive way to the economy and to the lives of ordinary South Africans. That we've just emerged out of severe lockdowns that have destroyed jobs, destroyed companies, and we don't have the kind of growth that one would suggest that we're having inflation driven by demand, such that an interest rate tool, raising interest rate is a right tool in order to manage what the Reserve Bank perceives as a problem. Instead, it pushes people over the edge, which is the point that you just made.
And I suppose, too, that small business is where we're expecting most of the jobs to come from. And so they need to be helped as much as possible. What do you think can happen? What can be done then if we don't raise interest rates? How do we deal with a potential inflation problem and yet find a way to assist businesses, small businesses in particular?
We have an economy that is not properly structured. We have a highly concentrated economy which lacks competition. I mean, you compare us with other countries, we have far too few banks. So there's no competition, real competition amongst the banks in terms of funding entrepreneurs. In other countries, you'd have a choice of over 100 banks. If one bank doesn't fund you, there's another 99 that you can go to, and they'll be competing for your attention. And secondly, we have too much. I mean, the concentration which limits competition in the market means that we have too much of a price arbitrage by operators. They can charge as much as they want because there's just enough for everybody who's playing in the market. And the other part is that we have too high a contribution of administered prices in the economy. I mean, the price of electricity, which is increasing at a high rate. I mean, we've seen that Eskom is looking at for a 20% increase, and that 20% is going to have a devastating impact on the inflation. And because of that, the South African consumers, there is really nothing that you can do with Eskom. You can't, just because you're paying more interest, and therefore they're taking more money from you, it doesn't mean that you're going to consume less electricity. It doesn't change. So the interest rate as an instrument in our economy for managing inflation is a blunt instrument because of those factors that I've just mentioned.
But to be fair, interest rates have been much, much higher in the past. Somehow we managed to make our way through it. Doesn't that leave a gap for a possibility that we could cope somehow?
Well, I mean, we have to leave. I mean, just because people have survived and they're still existing, it does not mean that they're coping. Right? I mean, life is life. I mean, there are people who are living in squatter camps in the kind of living environment that you and me would not want to see ourselves there. But they are living, right? But that doesn't make it right. The fact that people have to eke out a living, have to find a way to survive, does not make it right that we, as those that are running these institutions, should actually pile more and more of a burden on them, or make it more and more difficult for them to find opportunities. Now, you take SMMEs who tend to pay the highest interest rate as far as their debt is concerned. When you raise interest rate, you are actually increasing their cost of doing business. And I think for me, the whole thing of interest rate being used in order to lower, or rather to suppress runaway inflation. In our case, it could be that interest rates are also adding to inflation because they're adding to the cost of doing business in a manner that will mean that some of those SMMEs may have to actually increase prices in order to cope with the increased cost of the borrowing.
I suppose also another danger is that once these interest rates start rising, and the strict lending regimes that the banks have to follow, the informal lending sector starts to come to the fore a bit more, doesn't it? To mashonisa and that kind of thing. And that makes people even more vulnerable.
It does, because what would naturally happen is that with high interest rate, the default rates will increase. And when the default rates increase, the lenders they tighten the lending criteria, because they don't want to be losing money from the people that are defaulting to service their debt. And of course, like we mentioned before, the people have to leave. You know, you're not gonna not do something or not run business simply because the cost of a debt is or rather debt is inaccessible from formal institutions. They're gonna go to informal institutions and take a debt that is much even more higher, and there lies the interest rate fuels inflation type of a scenario. I think as a country we've been put into an unending debt spiral, and that we don't have economic growth, and then we then raise interest rate because of inflation that is driven by administered prices and the structure of the economy. And because we've raised interest rate, we don't have a growth, because we've taken money from the economy, whereby people are buying less goods than they were buying before interest rates were increased. So that on its own also contribute to suppressing economic growth. So we need bold leadership. And we've seen that in other countries, which the US and a number of European countries that actually injected cash into the economy. I think interest rates take cash out of the economy. But we know that we don't have growth. There's not a single person who's going to say we have the kind of growth that needed to be toned down. No, we don't. We actually don't have growth. We need to be doing everything in our power to get the growth. And other countries that are battling inflation, like the US, they're battling inflation that is demand-driven. They've done something in the economy where they're putting money in the hands of consumers, they put money in the hands of business, and they stimulated the economy to a point that the US is struggling. US companies are struggling to keep and to find employees. Right now, you're at a point where employment is stripping job seekers. And also people have more money and they are spending and prices are going out of control. When interest rates are increased in that environment, it makes perfect sense. But in our environment, we need lower interest rates in order to stimulate this economy. We need more money supplied in the economy in order to increase aggregate demand so that companies can grow. Existing capacity can be fully utilized and there should be an incentive to build additional capacity in the economy. We don't have, we have a lot of idle capacity and we have very little that is happening in terms of new investment that is going to increase capacity in the economy and bring in new products.
Mr. Msibi, we're going to have to leave it there. I was actually going to ask you about the finance minister. He's probably got a lot on his plate in terms of how to navigate his budget, but that'll be another conversation I think we'll have. In the meantime, thank you so much indeed for your time tonight.
You're welcome. Thank you.
All right, that's Mr. Khandani Msibi speaking to us about the ever-increasing debt burden that our citizens find themselves in, including businesses as well, and what the possible consequences might be in a country whose economy is not growing as quickly as it needs to.